I will begin this installment by mentioning that I am not a financial advisor, and this is for informational and educational purposes only. The strategy I'm about to outline involves high-risk, short-term trading of volatile assets. There is a real risk of loss. Market conditions are unpredictable, and by following this or any trading strategy, it is possible to lose some or all of your invested capital. Please do your own due diligence and never trade with money you cannot afford to lose. All right, so let's begin. The dust has finally settled on the most volatile week of the earnings calendar. Let's get straight to the numbers. We started Monday with $506. We just sold our position in XLK for $503. That is a $3 loss at a 0.6% drawdown for the week. Now, I know the feeling. You see red on the screen, your gut reaction is disappointment. You think we had momentum, we were up, now we gave some back. But I want you to zoom out. We started this experiment with 500. We are sitting on 503. We're still in the green. We are still profitable. We stepped into the ring with the biggest companies on earth, Microsoft and Apple, during their most chaotic week, and we walked away with a scratch. We didn't blow up. We didn't lose 10%. We paid a small toll fee, and we kept our capital safe. So what happened? We fell victim to the classic market phenomenon. Perfection was priced in. When you trade big tech earnings, the expectations are sky high. Microsoft and Apple didn't just need to be good, they needed to be flawless. While the numbers were solid, the market looked at the guidance, the future forecast, and hesitated. We saw volatility that we predicted. We saw spikes up, and we saw flushes down. But because we were in the ETF, XLK, we absorbed the shock. If you had bought call options on a single tech stock that missed guidance, you might be down 50% today. Because we played the sector, we're only down 0.6%. The thesis was aggressive, but the result was defensive. And sometimes defensive wins championships. I now want to highlight the most difficult moment of the week. It was probably Wednesday or Thursday night, right? After the earnings dropped. The market was whipping back and forth. The temptation to sell early or to double down and buy more was screaming in your ear. But we didn't touch the buttons. We stuck to the rule. We buy Monday, we sell Friday. We trusted the process over the noise. By selling today at 503, we have successfully neutralized the risk of the weekend. Whatever headlines break tomorrow, whatever geopolitical news or micro data hits, we are immune. We are 100% cash. That peace of mind is worth the $3 we lost. We live to fight another day because we didn't let one mediocre week turn into a bad emotional decision. So let's look at the trajectory of this $500 challenge. On week 1, we were down 4. Week 2, we were up 10. Week 3, we're down 3. We are learning the rhythm of the stock market. It is choppy. It is fighting for direction, but we are navigating it. We are holding our ground. Surviving Super Week with your account intact is a victory in itself. Many traders get wiped out trying to guess the exact reaction to Apple's earnings. We didn't guess, we managed risk. So now we are entering week 4 of our $500 swing trading challenge. Let's look at where we stand. We survived the volatility of Super Week with our capital intact. We are sitting on $503. We are profitable, we are liquid, and we are ready to redeploy. For the last 2 weeks, we have been obsessed with technology, streaming with Netflix, and cloud computing with Microsoft. But this week, we are changing the conversation. We are stopping to focus on how companies build things, and we are focusing on how Americans buy things. This week, we are rotating our entire 503 into XLY, the Consumer Discretionary Selector, because the economy isn't just about microchips. It's about the consumer's wallet, and right now the wallet is about to be tested. Before we talk about the specific news events, you need to understand that what we are actually buying. XLY is not a safe, boring basket of grocery stores. This is consumer staples. We are buying consumer discretionary. These are the things people buy when they feel good. When you look at this fund, you see the titans of American lifestyle. We aren't just buying retail, we are buying Amazon, Tesla, Home Depot, and McDonald's. But make no mistake, this ETF is top heavy. Amazon makes up roughly 20 to 25% of the entire fund. So when we buy XLY on Monday morning, we are effectively placing a leveraged bet on Amazon with a safety net of other retailers underneath it. Because Amazon is scheduled to report earnings, this is the moment of truth for the retail sector. We want to hear two things from Amazon. AWS numbers, is their cloud business growing? And the consumer health. Are people still ordering packages, or are they cutting back? If Amazon beats earnings, XLY gaps up. It's that simple. But there is a secondary catalyst this week that is arguably even more important, the jobs report. This Friday, February 6th, the government releases the non-farm payrolls. This is the single most important data point for the consumer discretionary sector. Why? Because if people have jobs, they buy Teslas and Big Macs. If unemployment ticks up, XLY crashes. We are positioning ourselves right in the front of this data. So now let's talk risk. Buying ahead of Amazon earnings and jobs reports is aggressive. As you can see, Amazon can swing 10% in a single day on earnings news. If we bought Amazon stock alone, a bad report could wipe out our entire 503 and set us back to about 450. That is why we use XLY. If Amazon misses but Home Depot and McDonald's hold steady, our losses are dampened. We are using the ETF structure to dilute the single stock risk, while still exposing ourselves to the upside of a good report. So as far as the execution plan, Monday morning, opening bell, 9:30, we'll take our $503 and we will purchase XLY. We're going to hold all week. We let Amazon news break. We let the jobs report hit. And then on Friday afternoon, we sell everything. This is the final stretch of earnings seasons. We are betting that American consumers are still strong, still spending, and still employed. Let's take our 503 and see if we can turn it into 510. I'll see you at open.